Seth Klarman is one of the most underrated investors of all time, and over the past 30 years with his investing fund, he has achieved an average return of 20%. Some people think he's a younger Warren Buffett, and he's actually written one of the most famous investing books of all time, a book called Margin of Safety, which sells for $3,000 a pop on Amazon. Now, the question then becomes, how does this great investor achieve such a high return for such a long period of time? How did he grow his investing fund to $27 billion and dominate the investing game? Well, essentially that's what we're going to answer in this video. I'm going to go over 10 very important rules used by Seth Klarman to achieve such a high return. Okay, this is a mistake that a lot of investors make, especially beginner investors and those working on Wall Street. You see, in a way, there are two types of investors out there. You have those that look at a stock and think of it as a ticker symbol on the stock market, sometimes going up and sometimes going down. And then you have those who view a stock as a business. The group on the left are always worried about the day-to-day prices of a stock, and they're very emotional when a stock goes up and when a stock goes down. The group on the right know that they own a business, and if that business does well, it does not really matter too much what the price of the stock is, as long as the fundamentals look good. At the end of the day, when you buy a stock, you own a business. This is why it's so important to determine, is this actually a good business that you want to own in the long term? Are they going to keep generating money and grow into the future? Looking at stocks as businesses instead of ticker symbols is one principle that has ensured a great return for Seth Klarman. Moving on though. So I just wanted to take you to this graph over here, which essentially shows you how fees destroy your long-term returns. Even menial amounts of fees that you pay can really eat into the amounts of money you can expect to make in the stock market. Okay, so essentially you have three lines here. All three lines achieve the same return, which is a 5% annual return, and all three lines start off with an initial investment of 100,000 euros. The blue line represents a fee of 1.5%, the red dotted line represents a fee of 3%, and finally the green dotted line has a fee of 5%. So fast forward 20 years and the blue line has grown to almost double at 196,000 euros. The red line has a return that is almost half of the blue line at 145,000 euros. And the fees for the green line are so high that it is actually ensured it has gotten a negative return, now worth less than the initial £100,000. So, rule 2 is that fees can destroy your long-term returns, so keep them as low as possible. And this is one reason why picking individual stocks is so good, because you don't have to pay an annual fee to own them. All you have to pay is a brokerage fee to buy them and a brokerage fee to sell them. Rule 2, avoid paying fees. So, this is Seth Klarman's opinion, and he believes that value investing is the best form of investing. I'm going to use an example of Seth Klarman talking about the GOAT investor, Warren Buffett, and when he bought Washington Post. Klarman says this. He said, "It is helpful to note that Buffett did not consider whether Washington Post was a component of a stock market index or about to be added to one. He did not weigh the market capitalization of the company or its daily trading volume in his purchase decision. He didn't worry about whether the stock was about to split or pay or omit a dividend. He most certainly did not evaluate the stock's beta or use the capital asset pricing model or consider whether its purchase would move his portfolio to the efficient frontier. He simply valued the business and bought a piece of it at a sizable discount." A lot of people overcomplicate investing, but if you can find a good business and pay a reasonable price compared to the value of it, you can't really go wrong. And this is why in most of my stocks, I go over the expected return and the intrinsic value of a stock before buying, which obviously I teach in my full investing course, and the link to that is in the description. And the thing about buying a stock, and this is an obvious thing about buying a stock, yet so little people behave this way, is try to buy the stock at a bargain price. You see, what most investors do when they see the stock's price going down, getting cheaper, is they look to sell the stock because they panic and they realize they don't know the true value of the stock. And because most investors panic and sell, this normally drags the stock's price down even further. What you really should be doing is buying more of a stock when it gets cheaper, generally speaking, especially if the fundamentals of the business haven't changed and it's just short-term news and emotions affecting the stock's price. Seth Klarman's fourth rule to investing is buy a stock at a bargain price. And basically what you do is buy stocks with a price below their intrinsic value and have high expected returns. All of this is obviously taught in the course. At the moment, Warren Buffett has a lot of cash in his portfolio, and he's not buying that many stocks. He's only bought 5 stocks this year. But every day, he's still going into his office, he's still skipping to work, as he says, and looking for opportunities out there in the stock market. But he's biding his time because he's only going to buy a stock when he can find it at a bargain price. So he's being patient, and at the end of the day, opportunity comes to those who wait and also have the right mentality, the buy low, sell high mentality. So I don't know if you guys have ever heard of this theory, but some professors at university had this theory that the market was efficient, and a lot of people buy into this. Basically what this theory meant was that every stock's price represented the true value of that stock because all of the information is out on a stock and that it is impossible to beat the stock market. I'll give you a recent example, and there's many examples out there which prove the stock market is not efficient. Let's just look at the price of Facebook over the past year. So it started midway through 2018 with a price of about $215. Then people started getting worried about privacy issues and users leaving Facebook. And what do most investors do? They react with their emotions. The price of the stock fell almost 50% in less than half a year. And do you really think the actual value of the business can fall that quickly by 50%? Of course not. And this was around the period, where I was saying there's a lot of opportunity with Facebook stock. And there are plenty of examples like this which prove the stock market is not efficient. Facebook was just the first one that came to mind. And because of this, people like Warren Buffett can beat the stock market over the long term. Warren Buffett, he's beat the stock market over the long term by 11%, which really adds up. It was about 11 years ago when the stock market crashed. It was late 2007 to early March when the stock market crashed over 50%. During that crash and the periods after that crash was the best time to buy into the stock market. Obviously speaking, you want to buy things as low as possible and sell as high as possible. But in order to buy as low as possible, you need something called liquidity, something called cash or cash equivalents, which you can use to buy stocks when they are cheap. This is why it's always important to have a certain percentage of your portfolio allocated towards cash equivalents so that you can snap up opportunities when they come. Let's look at that stock market crash one more time. See, the thing about this period here is no one exactly knows where the bottom is. People will always guess at it, but no one knows for sure, which is why you focus on what you can control, and that is average down on your positions. Keep buying stocks when they get cheaper. Even if you average down around here, you would have still gotten 100% return on your total investments over just 10 years. Remember, the cheaper the stocks are, the better. A good investor should always be prepared for all market conditions. They should look at having portfolio hedges like gold or cash, diversified through sectors and even countries. But often, if one position is doing really well, it can put your portfolio out of balance. And this is why it's always important to look at our portfolio and try rebalance it maybe every couple of months. Investing is a skill. It's a process that takes time to learn. At the end of the day, generally speaking, those that know more, have a clear strategy, and stick to that strategy will win the investing game in the long run. And that is why it's so important to keep watching YouTube videos that teach you about investing, that teach you about different stocks, that keep looking at what the experts like Warren Buffett are doing. It doesn't have to be YouTube. It can be reading investing books or articles, or watching TV or CNBC, or listening to podcasts. But try to learn as much as you can about investing, because the more you know, the more your investments will grow.